Hey guys, what's going on? In this video, we're going to cover something of great importance, and that is move expansion versus move contraction. How does it relate to trading weekly options? And specifically, what are the probabilities of a move contraction after a move expansion? How can you utilize it? And guys, this is a pretty advanced subject. I would expect you to understand the 13 Market Moves curriculum to better understand the information in this video. So if you're trying to advance as a trader, pay very close attention, because this one aspect that I'm about to show you is probably the greatest learning lesson that derived from this last 10 days of trading. And so I'm going to explain it on the charts. So chart number one is the basic chart of S&P 500 as we have predicted the 3-3-3 sequence. Now understand, when the move is contracting, what happens to the option premiums is you're going to have a situation in a sideways market, right? Just after you had a nice move higher and things are stalling out, most of the traders would expect this to break out to the next leg higher. Now, we warned you that's not going to be the case this time because we're following some historic analogs, and more on the historic analogs, guys, in the next video. Make sure you don't miss that one. It's going to show you exactly what will market actually do next. So talking about options premiums, when the market is going to switch to a bullish side, such as in case right here, and it's going to go sideways, your options premiums on both sides, on calls and put sides, they will decrease in value. So this actually creates a huge buying opportunity for you. You want to buy options when we trade directional options, when premiums actually go lower. And so this 3-3-3 move has made certain traders in our group anywhere from they went from 50,000, some guys went up to 700, 800, 900,000. And important to understand what happens next, that we place a huge bet on a 90% probability outcome and it stalls and it doesn't work. So a lot of these gains, unfortunately, were given back to the market. Nonetheless, this is a huge lesson to understand and know how in certain rare market instances, you have to be very careful with this move contraction. Unfortunately, it is not going to be as apparent as we would like it to be. So you still have to stick to your strategy, and you want to bet in a 90% probability outcome instead of trying to bet on something like what happened actually in this instance, which was a very low event of an outcome, what has followed the 3-3-3 sequence. For those of you that are not sure what is a move contraction or expansion, let me just state real quick for better understanding of this video. There's such thing as for you to track how much does the market move on a particular day. For example, a stock, like Tesla can move $40 on certain days. It can move $100 on certain days. It can move just $10 on certain days. So when Tesla daily trading range could be 20, 30 bucks and it stays there for a little while, the day when that trading range starts expanding, so maybe the last few days is trading at 20, 30 bucks, and you notice the day where now the trading range is expanding, it's going higher to $40, $50, $60. That would be an expansion on the move. So as you can see right here, we have an expansion. We have bigger candles. So in other words, the market is making a greater move before the move is actually contracting. So this sideways trend would be a diminished size of the move. So the move is contracting, the daily move. We're pertaining to how many points does a particular underline moving up, down, between highs and lows on a certain day, between the previous closing of the trading session. So what you have here, normally in any 3-3-3 sequence, you would have a move expansion. The move expansion allows you to make a ton of money, especially if it is preceded in this major daily trading range shift. So we went from smaller size move where the market was going sideways, maybe trading down to a max of 40 points lately on this in this particular interval on a time frame, and then you go to a 3x, 4x of that daily move. So instead of the market now going up or down 40 points a day, now you have a market going down by 130 points. And so when you look at the relationship of this candle, the candle size, let's say to the prior candle size, so this candle is a lot smaller than this candle. So in this particular case, we're talking about a move expansion. A move in the S&P went from 40 points, it expanded all the way to 130 points. Okay, so that's the condition of a move expansion. You go for a smaller size daily move, which will be portrayed anywhere in this chart by a smaller candle. When the next day candle is substantially higher, that would be a move expansion. Now, it doesn't mean that the market is dropping or going lower. A move expansion could be when you have, for example, smaller drop day like this, and then the market shifts higher. This would be a move expansion. So when we're talking about contraction or expansion, we're not talking about bullish or bearish. We're just talking about the size, okay? And it's important to understand the size of the move because it's the shift that determines the premiums in your option. So there's a few factors that determine the premiums of the option. It's the size of the move and the speed at which the move is actually expanding. So the option premium, for example, in this case, when you switch from a small red candle into like a candle that's twice the size of this red candle, this would give a rather substantial boost to the options premiums, especially on the call side, especially on the second day follow through when you get another green day and another green day, right? So now this is the best setup right here for options premiums, because when you go bullish sideways, this is your biggest money making opportunity. This is the point where your options premiums are priced cheaply, because to most of the market participants, it is not clear yet that the market is about to fall the hell out. And so you're buying options here on the put side really cheaply. You're getting a bargain. And then so when the next day, we basically predicted there's going to be a beginning of this major 333 sequence, which by the way, guys, is very, very rare. But to nail this to the point before that whole sequence plays out puts you in a situation to profit tremendously from the market. And so normally if you study the historic cases, you would know what happens next. So I'm about to show you that. But this 333, guys, in this type of sequence, your put option premiums are going to increase substantially. Each day you're going to have a gap down and a further drop, a gap down and a further drop. So where most of the traders go wrong on such a sequence, 99% of the traders, they're going to miss this entry point. And then the next day they're going to be wondering, oh my God, well, it's probably too late, right? Because you just went for this nice upsize move to sideways trend. The market is calm. Nobody's seeing the storm. And the first day you get this extended move after getting used to maybe 40, 50 points a day. Now you're down 130 points in the market. A trader looks at this situation and they're like, well, it's too late to get in. And so they don't get in, they miss the trade, they miss the next morning gap down. And at that point, they're like, oh my God, well now, certainly I'm late to buy puts here. And then the third day, they're waking up and the market keeps going lower. And at that point, they break and they say, well, hell with this. I'm definitely buying puts now. Well, what you should know from the historic probabilities of 13 market moves, we go 20 years back at this point. I mean, guys, there's never been a situation where you would have 3, 3, 3, and a fourth move 3. In other words, a fourth gap down. You could have still a red day, but that fourth day normally would be a move 2 or 7, which both begin the day with a slight move higher of some kind. So, and that's exactly what happens here in the sequence. But understand that you've got to know the sequences first to capture the first part of the move, which would be this major move lower. And then you just got to focus on the probabilities, which in this case, they didn't work, but not in the case, they would work in majority of the circumstances. So at this point, after witnessing this 3-3-3 sequence, guys, which is highly bearish, understanding that the next outcome on the next day's move cannot be another 3, going back 20 years, all right? We understand that at that point, the market is likely to bounce as it does in 90% plus cases. So for example, to give you a good historic example, we're looking now at April 1994, where we had a move 3-3-3. A couple of prior candles, there are not 3 moves here. Here's move 2, for example. But if we're focusing on these last 3 candles, they're 3-3-3 moves. And you can clearly see that after that, the market sets a low. It's a move 13. So after a huge 3-3-3 sequence, the probability of getting a 4th 3 is highly, highly unlikely. As a matter of fact, it has never fucking happened. That's how unlikely it is. So at that point, where most of the traders, they're still like, well, no, let's, clearly the market is crashing, let's go buy more puts. When you have a lot of negative headlines in the market, where everybody, right, is just bearish. I mean, the people that were so bullish a week before, now they're turning bearish. People that have been bulls for a while, these guys on CNBC, now them guys are turning bearish. This is the worst time to be a bear in like 99% of instances. So this is the time that would actually make sense to switch directions if you study multiple historic examples. This is not your time after 3-3-3 moves. You don't go on the 3rd day of a move 3 and load up with puts. That is the worst fucking thing you can do. Because by definition, in 90+% outcomes, you're gonna have some kind of pump. You're gonna have some kind of bounce. So you don't wanna bet in the direction of the lowest probability. You want to start betting in the direction of the highest outcome based off multiple instances in the history. So based off the current sequence that we've had on the 3-3-3, the highest probability outcome was a 10-7-7-7. Because not only this event here, the 3-3-3, was such a huge expansion of the move, okay, in most of the instances when you get these 3 gap downs back to back, you ultimately will arrive at a gap up. We can call this last gap the exhaustion gap. You may be familiar with that. But at that point, it is highly, highly unlikely to have a 4th gap down. In most instances, it's going to be a gap up. And especially, guys, when you combine that with other market conditions, such as the VIX. So very phenomenal action on the VIX in the last 10 days, despite of the market breaking lower, despite of us going for this highly bearish sequence of 3-3-3. Look at what happens to the VIX. Like, it just completely fails to break out. This 34 level is just, it's not a big deal for the VIX. There's been multiple instances in the last few years when we're in the middle of a bull market where VIX shot up to 50, 70, 80. It has happened. So the phenomenal bullish divergence here on the VIX confirms that the market is done dropping, that we shouldn't be expecting another 3-3-3 sequence here. And what would happen in most instances is, just like I pointed on this 1994 example, is you would have multiple moves higher, right? These are huge size candles. The key word here is the huge size candle. So for example, the last 3 candle size wise is this move 13 candle is even bigger. Like, in other words, the market drops one last day, it reverses. This candle is greater in size overall than the last 3 candle. So a couple of these candles can put you up, guys. They can erase a lot of these gains rather rapidly. As you can see, you could be back to this level of the second day of the move 3, which would put us easily back to, slightly above 3,900 level. So very important information to understand that instead of getting an increased size move to the bull side, as you normally would get with a move 13, okay, we had a decrease in the move. So we went, normally in a situation of a 333, you're going to go for a move expansion, move expansion, move expansion that will ultimately result in a move expansion again, but to the upside. And so we had a very, very rare circumstance here following the Federal Reserve meeting. Normally the volatility and the size of the move would expand. And in this case, because the market has been dropping so much going into the Federal Reserve meeting, we had a very astronomical probability of an expansion of the move to the upside, which we did not get. Instead, we got a little bit of a bounce. We got a little bit of the bounce right off the Federal Reserve announcement. We got a somewhat of a good size reversal the night after, which would coincide with this candle right here, 94. But look at that. After that, it's a 777. It's just bullish move. They're buying the dip, buying the dip, buying the dip. Okay, so we just didn't get an as accurate of a move expansion, okay, which killed a lot of options premiums on the bull side. So, but this is very rare where the market keeps dropping and it keeps setting new lows and the VIX just fails. This is not the time where you want to be a bear. VIX fails to break out higher consistently when market keeps dropping and dropping and dropping. This is a time for you to check the situation, say, hold on, what is going on here? Okay, why is VIX not going higher? Is VIX completely broken? Is the system entirely manipulated? Okay, that's what most of the traders think, right? But a much simpler way to view this is, look, these are very rare market circumstances. The market is selling off, but it is selling off in a very, very orderly fashion here. This is why the VIX is not breaking much higher from this 34 level. We can't say that it's going lower, but we can't say, I mean, this is clear, right? The VIX is failing to break out. I mean, it should have been on the next day after the Federal Reserve, VIX should have been here. It should have been at 40. There's no reason on that reversal why VIX shouldn't have gone like right here to a 40 level. But it didn't. It actually dropped in relation to the prior day. So VIX actually went lower instead of higher. This is a huge, huge case for bullish divergence, guys. And at the same time, if we study instances where VIX showed us a bullish divergence like this, normally we would have a huge move to the upside in the actual stock market. So this is why in some instances like this, you see these huge candles, right? They're upside candles. The market may initiate lower, but by the end of the day, you're way higher. And so this was a very rare event where you had a lot of market sectors, a lot of bullish divergences everywhere, and yet the market failed to move higher. It moved higher slightly, and it moved higher slightly on Friday. But overall, the move to the upside was contained. Instead of making a move of maybe 200 points on S&P, the move was contained to just 40, 50 points. And so that's going to be bad no matter what. That's going to be bad if you're trading directional options, if you're trading puts. That's going to be bad if you're trading calls. It doesn't matter how you trade this. When the market is going through a move expansion, look, big red candles, okay? If you're trading puts the next day, well, you can't really make much money on puts because look, the move is contracting, and you can't. And if you're playing for a big breakout to the upside, which is what would happen in 90% of instances here, you can't really make money either. It gets slightly higher and then it reverses and it ends in the middle. So you can't make money on calls. You can't make money on puts. All right. So from a standpoint of trading weekly direction options, this was the least probability of what was going to transpire on Thursday and Friday. The market just basically stalled, and it gave us a move contraction instead of a move expansion. So hopefully that makes sense. And just to help you view this a little bit better. I mean, clearly you see these candles, they are smaller. All of these candles here, guys, they're smaller than the size of these candles. So you can look at this chart and say, well, overall the market is still dropping, sure, okay, but you know, there's clear bullish divergences here, guys. Even though the market is not making that 130 point move that we had here, 130 points, you know, more bigger move, expansion. Now we have smaller move. But look what happens to the volume. We get this crazy bull candle right here. This candle is even higher than the bullish volume we've got right here before all this bullish run has happened right here, right? So the bullish divergences are omnipresent in this market. But when you combine that with the move contraction, even with high probabilities of a bullish reversal that had like 90% case this week, okay, when the move stalls, like, it's the worst thing that can happen to you as a short-term trader. So you get killed on those premiums, you get killed on the size of the move because it's contracting. You start making a little bit of money, but then the move fades. You can reverse the position, trade the other. As soon as you reverse your position, the move stops to the downside. You're trapped. This is a situation where you're trapped. And this is not going to happen very often. So if we have another circumstance at some point this year where we have a move 333 where you have this, okay, you're still better off betting to a move expansion probability, because this is an abnormal circumstance, okay? I'm going to show you exactly when was the last time we had such an abnormal circumstance, and that was exactly in June of 1974. So this is a chart of S&P 500 dating to 1974. We've been using this recently as a historic analog, but even going back and analyzing this situation, which almost date-to-date matches with June now of 2022, you see that even the bounce here in 1974, it was much greater than the bounce we just had. So this recent bull run right here we just had, that would be matched on the prior picture of S&P 500 I was showing, and this bullish move right here, guys, I mean, we should have had a much more bullish move. But clearly, looking at this chart, you're like, oh my God, are you really saying we're gonna go drop all the way through October of this year? Guys, find out in the next video. I'm also gonna be giving you the best trade that was unanimously the best trade for anyone that traded in 1974. So if you wanna know what could be the absolute best trade for you to take between now and October of 2022, guys, I'm going to reveal it in the next video. Now, if you want to understand more move expansion, move contraction, how to apply it, you know, how to benefit from observations like this in the market as a day trader, trading weekly options, make sure you visit 13mm TV. If you don't know all the 13 market moves, guys, study them. You got to understand the moves. You know, first, before you can go to a few $1 million, you got to nail the move 333, and then you got to nail the follow-through sequence. At one point, if you devote your time to studying this information, you will persevere and you will beat the market. You will be a huge success story.
Oh,